progress.
Hello. So today we will continue our discussion on the estimation of beta. Um, Normally, beta can be, we can look for beta from the data source, like data providers such as Bloomberg. But in this case, is this the case that the beta that run from the regression, the data that provided by the data provider cannot be used. This will be the case that I list here for private company, right? For private firms, there are no historical data, so we cannot estimate the beta to the regression model. So we have to estimate our data by looking at data of other company. Right? In the case of private firm, for thinly traded company, for illiquid stock, the historical data may not be valid to use in the model to estimate the beta. Or if we run the model to estimate the beta, but when we run the regression model, R square is low, high standard error. So in this case, we might not want to use that data purely. Or if there, in the case there is a structural change uh, in terms of the company business itself, or the structural change in the macroeconomic or the macro pictures. So in this case, when we run the beta by using historical data, it might not be valid to be good measurement of the risk in the future, right? Or in the case of if there are any change in the market portfolio mix, if there are some sector, the mix of the sector that contribute to the market portfolio change. So in this case, we need to, estimate new beta based on other company. And when we talk about other company, we will, so if this case happen, right, thinly trade company, thinly traded stock, um, for the stock that when we run the regression, low R square, high standard error, if we expect structural change in market portfolio, or even for private companies. So in this case, we will need to estimate beta by looking at betas of comparable firms. When we say comparable firms, it's referred to firms with similar determinants of risk. Okay, so I list determinants of beta or determinants of risk here, right? So we need to understand that a company, normally there are the risk of a company normally depends on three factors. First is the business that the company is in. So that's related with business risk. Okay. So the business risk is determined by the business that the company operate. Company operate in similar business, supposed to have similar business risk. For example, company in infrastructure sector, that is a basic need, the risk tend to be low compared to like the company in a cyclical sector or like consumer discretionary sector, like so in that case, risk will be higher, right? So that's the first determinant of risk, business risk. The second and the third type of risk are operating risk and financial risk. Operating risk relate to the cost structure of a company, the operating leverage, which determine the cost structure. A company which with high level of fixed cost compared to total cost will have high level of operating leverage, and operating risk. And for financial risk, it is determined by the capital structures of a company, which is the financial leverage. A company with high level of debt will have high level of leverage and high financial risk, right? So we want to find, so now we want to estimate a beta of the company that we analyze based on beta of comparable firm. So when we say comparable firm, this means firm with, we would like to find firm with the most similar level of business risk, operating risk, and financial risk. But in the real world, normally, okay, we can find firms in similar business. So we can find this. So in terms of business risk, we can find firm with similar level of business risk. But in terms of operating risk and financial risk, sometimes we cannot find a company with, exactly or really close level of capital structure or cost structure compared to the company that we analyze, right? Especially the capital structure, the financial risk, the level of debt. So in this case, we need to adjust, we need to take out the difference in the financial leverage, or if the difference in cost structure, we need to take out the difference in operating leverage first, and then when we take out the financial leverage and operating leverage, we call it unlever. We unlever the risk of the beta of the comparable firm first, and then we re-lever it back to the target financial risk and operating risk of the company that we want to analyze, right? To make it simple, so I will tell you about the step, right? So for the step in estimating beta for the company that we analyze, first we need to find comparable firm in the similar business, the most similar business. When we talk about similar business, we would like to look at the market, right? The demand determinant, like the market, the customer segmentation, or the product. So we would like to find company with similar, that are in similar business, so-called comparable firm, right? And then when we find comparable firm, it can be just one company or many companies. It depends, right? So, and then we look at betas of the comparable firm, right? And if the comparable firms have different level of debt, the capital structure, different level of financial leverage than the company that we analyze, then we need to take out the difference in financial leverage by taking also when we take out the difference in financial leverage of the beta of the comparable firm, we have unlevered beta of the comparable firm, right? I will tell you the formula later. And if we find out that the comparable firm also have different level of operating leverage, different mix of the cost structure, we need to take out the difference in operating leverage by, from unlevered beta of the comparable firm, we take out the difference in operating leverage to come up with so-called pure business beta. So this pure business beta reflects only the business risk of the comparable firm, right? Because we already take out the impact of the financial risk and operating risk. So after we have pure business beta of the comparable firm, we re-lever it back to the target cost structure of the company that we want to analyze, and the target cost structure of the company that we analyze, we come up with the unlevered beta of the company that we analyze, and then we re-lever it back to the target debt ratio of the company that we analyze. So we have the lever beta of the firm that we analyze. So this is basically the step. And in practicals, normally the companies in same industry normally face similar business and operating risks. So most of the time, even we want to estimate beta, we look at only the difference in financial leverage. So we basically, from the law beta of comparable firm, we take out the difference in financial risk of the comparable firm by taking the financial risk out, we have a level beta, and then we relabel it back to the target financial structure of the company that we analyze. So that's the step. Okay. So to give you more understanding, I will go to the next slide. Okay. So for this slide, okay, so this slide is about to adjust for financial leverage of the comparable firm. So the step, right? We find comparable firms compared to the firm that we want to estimate the beta. We look at we try to find comparable firms. Okay, so after we find a comparable firm, we have the beta of that comparable firms, and then we take out the difference in financial leverage using this formula. Okay, so this is the beta level of the comparable firm. But since the comparable firm might have different capital structure, different level of debt compared to the firm that we analyze, so we take out the we take out the impact of financial leverage from this level beta of the comparable firm by using this formula, right? So we divide level beta by 1 plus, actually, like, it's 1 plus debt to equity. Debt to equity is the source of financial risk, right? So is this 1 plus debt to equity? But since debt, the interest on debt provide tax shield benefit, it is the interest on debt is an expense that is tax deductible, right? It's provide tax shield benefit. So we also need to multiply this debt to equity ratio by 1 minus tax rate to take into account the tax shield benefit of the debt. Right? So we divide this beta, the level beta of the comparable firm, by this, right, 1 minus debt to equity multiplied by 1 minus tax rate. This is the debt to equity of the comparable firm. Okay, I make a note here. This is the debt of equity of the comparable firm because we want to take out the leverage of the comparable firm, right? This is not the debt of debt to equity of the firm that we analyze. This is the debt of equity of the comparable firm, and so basically it is the market value of the debt to the net debt. Net debt means debt minus excess cash, right? Net debt to equity of the comparable firm using market value during the period of beta derivation. Why we use market value? Because the market value represents the actual cost, right? Not the book cost, not the historical cost, right? We want to use the market value because it represents the current the level of debt to equity during that time. Okay, so just to conclude this, right? We find comparable firm. We have the unbeta of the comparable firm. We take out the impact of financial leverage by dividing the level beta of comparable firm by 1 minus debt to equity multiplied by 1 minus tax rate. This debt to equity, it is the market value of net debt. Net debt is debt minus cash. Net debt to equity, market value of net debt to equity of the comparable firm during the beta derivation period. Okay, so after we adjust this, we have unlevered beta of the comparable firm. And from this unlevered beta, we re-level it back to the target debt to equity ratio of the company that we analyze, right? Okay, so this DE, the green color, is the target debt to equity ratio. It should be the market value of the debt to equity ratio of the firm being analyzed. Okay, so then we have the level beta of the company. Okay, and we can use later in estimating the required return of the company that analyzed. So for this slide, any question? Okay, so if you don't have any question, let's continue to the next slide. So this is the example of how to estimate the beta of based on comparable company, assuming that the company has a level of business risk and operating risk. So we look at only the difference in financial leverage. Okay, and in this example, actually, okay, when I say comparable firm, right, it can be one company, two, three, four company. It depends on your judgment and on which or like which company you think is appropriate. It's mostly similar. It's mostly reflects the risk of the firm you analyze, right? So it can be any company, or it can be the company that you analyze itself. In the case that, for example, if the business, okay, like for example, if you want to analyze this company, you run a regression model and you have a beta for this company. This beta is based on historical data, right? So it reflect risk in the past of the company. But in the case that the company, business model may change the future, so in this case it's the financial leverage, which is the financial risk. If you expect the company capital structure to change in the future, is a structural change in the capital structure. So in this case, you may want to re-estimate the beta based on the historical beta of the same company, but with different capital structure, with the different debt level. So in this example, it is the case that a structure change that the companies here there are two companies, Home Depot and Lowe's, which are the two home improvement companies. So they are in the home improvement business. But in this case, the analysts expect that the debt ratio of a company in home improvement business will change in 2008 compared to 2006, with higher gearing ratio, higher level of debt. A capital structure, like we know that company should run at an optimal capital structure, right? In the case that the company can have higher level of debt in the optimal capital structure, is maybe because of the lower business risk of the industry, right? So in this case, they expect higher level of debt in the future compared to the past. So if when they run regression model, regression beta, this is based on historical number. But since the analysts expect debt level to increase in the future, you can see that, okay, let's suppose this is the regression beta that ran from the data in 2006, and debt to equity ratio, the market value of debt to equity ratio in 2006 is this level. And an analyst expect debt to equity ratio to increase, right, in 2008. So in this case, if the analyst does not adjust the historical beta, it might underestimate the risk, right? Because of the lower debt ratio in the past compared to the future, right? Compared to the expected debt ratio in the future. So in this case, the analysts need to make an adjustment. So what the analysts need to do is from this raw beta, from this regression beta, right? This includes the financial risk. So the analysts need to take out financial risk from this raw beta by using this formula. And you can see that include all the interest-bearing debt and minus cash to come up with net debt. For debt value, right? Debt value normally market value of debt uh, may not be much differ from the book value. Why is that? Okay, we know that. Okay, maybe I refer to the first class, actually the first slide that I discussed with you, that value of any asset, right? It is the present value of future cash flow discount by the discount rate that reflects the risk of the cash flow, right? And for equity, of course, cash flow is not constant. It's changed depending on external factor, internal factor, and so as the risk of the equity. So share price can change. Market value can be totally different from the book value of equity. But for the debt, right? For the debt, since debt is a fixed income securities, so cash flow is fixed. If you hold the debt until maturity, right, the cash flow is set fixed. So the only factor that will cause the change in the market value of debt is the risk associated with the cash flow, right? But so normally, if the risk doesn't change, the value of that market value will be very close to book value. So in many cases, analysts refer to that value to, they can sometimes they use the book value, but theoretically you should use the market value. Okay, so in this case they didn't say whether this market or book, so that I give you explanation. So here, from the law beta of these two companies, right? An analyst expect a change in capital structure in the debt level, higher debt level. So they take out this leverage for the financial leverage from this data first by applying this formula. So the debt to equity ratio, market value of net debt to equity ratio is calculated down below. All right. So with this ratio applied in this formula, we have unlevered beta. So this is the beta that already take out the financial risk. Okay, and in this example, they kind of average the value to come up with industry average, a level beta. Okay, and as a practitioner, myself as a practitioner, for me, I might not choose to use the average value because, so for example, if I want to analyze Home Depot, I will choose to use this number and re-level it to this debt ratio. The reason that for me myself as a practitioner, I might not decide not to use the average number because there are large difference between the two numbers. So it means that in terms of business risk or operating risk of these two companies, it can be different. So it might not so-called comparable or very similar. So I will if you average the value, it may, in this case, it may overestimate the risk of Lowy and underestimate the risk of Home Depot. But so for me, I will re-level from its own beta. But okay, for this example, they take an average value, so-called industry unlevered beta. If you want to estimate industry level beta, I suggest that you should, include more company in the industry. Okay, but this is the example anyway. So they just, just to try to show you how to come up with the industry beta. And from this industry beta, they level it back to the target debt to equity ratio of each of the company, right? So for Home Depot, the historical debt ratio is just debt to equity is just only 0.26. They expect the debt to equity ratio to increase to 0.51, and for Lowe's from 0.16 to 0.32. So from this number, the industry beta and level beta, they level it back to the target debt to equity ratio. So they, by having this number, using this formula, right, multiply the unlevered beta by 1 minus debt by 1 plus debt to equity ratio multiplied by 1 minus tax rate, and they have this level beta. So, and this beta can be used in the CAPM model to estimate the required return to when we want to value a stock. Okay, so any question on this example? Okay, so if you don't have question, in this slide, okay, say that unlevered beta, okay, is how about unlevered beta is the level. When we talk about unlevered beta, is this the beta that already take out the financial risk? So this unlevered beta reflects only business risk and operating risk. And this slide is suggests that after when you estimate unlevered beta is supposed to represent business risk and operating risk. So the beta should, the level of beta should really reflect it. If, for example, and this is the kind of plot the level of unlevered beta by sector, right? And you say that okay, the level of beta should reflect the business and operating risk of the sector, of each of the sector compared to the economy, right? For example, water utilities is very stable cash flow, low risk. Beta should be lower than the average value, which is 1, right? The market average, which is 1 beta, number 1. Well, 1 is the market beta. But for the sector with more cyclical, like cyclical company or electronics, like high ticket item, is more risky. It's riskier, so compared to the economy, so the beta should be higher, right? So the reason that I show you this slide is because in practice, if, for example, you analyze a company in like, okay, commodity chemicals, it's supposed to be cyclical, and your unlevered beta that you estimate is only 0.4, for example. So you must recheck whether it's correct or what are the reasons for the beta, for the unlevered beta of this company to be lower than 1, given the industry that the company is in. All right. Until this slide, are any student have question? If you don't have question, then the next slide, it talk about the adjustment of the operating leverage. Okay, so in practice, the most different in terms of the risk is the financial leverage. Analysts normally assume that company in same industry normally has the same level of operating risk, which is the similar structure, similar level of cost structure, the cost to total cost. But if you find large difference in the cost structure of the comparable firm and the company that you want to estimate, the beta, you need to take out the difference in the cost structure in the operating leverage as well. So if you want to take into consideration the difference in operating leverage as well, you need to from unlevered beta. So after you take out the difference in financial risk, you have unlevered beta. So from the unlevered beta, you take out, so this one from the unlevered beta, you take out the difference in cost structure by dividing this unlevered beta by 1 plus fixed cost over variable cost, right? Because fixed cost is the source of that fixed cost over variable cost, no tax. In this case, it's not related to any tax shield benefits. So you don't need to multiply by 1 minus tax rate like what you did in here, right? So this one is 1 plus debt to equity ratio. That is the source of risk, right? 1 plus debt to equity ratio, but you need to multiply this by 1 minus tax rate because of the tax shield benefit. But in this case, you divide it by 1 plus fixed cost over variable cost, right? So from the unlevered beta, you take out the difference in the, you take out the operating risk by dividing by 1 plus fixed cost over variable cost. You have pure business beta of the comparable company. And from this pure business beta, you re-level it back to the target fixed cost to variable cost of the company you analyze. This is the fixed cost to variable cost of the comparable company. This is the fixed cost to variable cost of the company that you analyze, right? Okay, and after you from the pure business beta, you multiply by 1 plus because over variable cost of the company, you want to estimate the beta, you have unlevered beta of the company you analyze. And from this unlevered beta, you multiply by 1 plus debt to equity ratio of the company you analyze, multiply by 1 minus tax rate. You have levered beta of the company that you want to estimate the beta that you analyze, right? So any question on this slide? Okay, so if there are no questions, so now we can estimate the beta, right? So when you come up with beta, the beta you can look at beta from data provider source from, okay, actually the approach to estimate this beta, right, the company beta, you can run the regression by yourself, right? Beta is the slope coefficient of the regression between the stock return and the market return. Or you can look at the data that provided by data provider. Normally, practitioners use the data provided by Bloomberg, right? So, but if the regression data doesn't seem to fit well, low regression, low R-square, high standard error, or if you find some structural change in the business of the company you analyze in the market portfolio mix, or if you think that the historical data to run regression, there are problems with the data. It can be because of low liquidity of the stock, or if the company is, you want to estimate the beta, it is a private company, no historical data. So in this case, you need to estimate the beta by comparable company, the approach that we just finished discussion. Okay, so three approaches, right? Running the regression using the data provider, or estimate the beta by from comparable company. Okay, so after you have the beta, you can plug in the CAPM model to estimate the required return of the company that you want to value it, right? This is the CAPM model. Okay, so we just finished the CAPM model. The CAPM model, it is the equilibrium model that is this the single factor model, right? Single factor model. But so the next one we're gonna talk about multi-factors model. Okay, for CAPM, it is single factor model. CAPM, in CAPM, it is based on the belief that the factors that determine return of a company, it is the market risk, right? The factor that explains stock return is this market risk. Is this just the one factor that uh, explain the return or the risk of a company, right? But in the multi-factors model, you can add other factor if you believe that this factor can have significant impact on the company risk and the required return. And the most commonly used or talked about multi-factor model is the pharma French model. Okay, actually, when I already referred to pharma French when we discussed the efficient market hypothesis. Actually, pharma is the Eugene Pharma, right? He is the one who proposed the efficient market hypothesis, and he also talked about the anomalies, right? The size impact and the book to value impacts, cross-sectional anomalies that we already discussed in our first class, right? So Pharma and French, they believe that in addition to the market risk, actually like what is market risk premium, right? You know that market risk premium is the average systematic risk that each company contribute to the market portfolio. It's supposed to be enough to explain the risk of a company. But Pharma Friends found out that there are anomalies that for small cap firm, expected return of small cap firm supposed to be higher than large cap firm of similar risk, of similar market risk, of similar market beta. For a small cap company and a big cap company, if those two companies has the same level of market beta, but small cap firms still require higher return in the past when they look at empirical data. So they add this term that explains the source of return or the required return that's supposed to be higher is called small minus big. So small minus big represent the return of small cap firm over big cap firm. Large small firm over big firm, right? When we talk about small cap, it's small cap capitalization, small market capitalization. So what is market capitalization? Okay, let you tell me, because since the beginning, I haven't asked you any questions. So how do we calculate market capitalization? Shayutha.
So I think there are two main ways. The first way is to multiply the stock price in the market with the number of stocks. And the next way we could look at the equity value, I think, if it's a private company.
All right, but equity is, if that the equity value is the book value, right? So that's not the market value, but basically market cap, it is the market price. So that's the market value. We multiply market price by the number of shares. So that's represent the market value of equity. All right. So when we talk about small cap, so it means lower level of market value of equity compared to the other company. Big cap has higher level of market value of equity, right? And so small minus big, okay, this is referred to small cap minus the return from small cap stock, or minus the return from big cap stock. Okay, small cap supposed to have high return, supposed to be, so to it suggests that small cap firm require higher rate of return compared to big cap firm, given the same level of market risk. So small cap firm will have positive size beta. So this is size beta, right? Size beta multiplied by small minus big, the return from small cap minus big cap. So small cap firm supposed to have positive size beta. Okay, and the other term that Pharma Friends suggests that we should add to the CAPM model, it is so-called high minus low. So what is this high minus low? It is the return of high book to market ratio minus low book to market ratio. Okay, book, it is the book value of equity. Market, it is the market value of equity. So basically the book to market ratio is the reverse ratio of the price to book ratio, right? Price to book ratio is the share price over the book value of equity per share, right? So the reverse ratio is the book to market, okay? And why is this high minus low? Is this refer to high book to market minus low book to market? So basically, a company with high book to market, it is a value stock, while the company with low book to market, right? Low book to market means that share price is a lot higher than book value. So it's represent a growth stock because for a growth stock, a company, an investor are willing to pay higher price compared to the book value because they pay for growth potential. Okay, so high book to market is this value stock. Low book to market is this a growth stock. And Pharma Friends suggest that for value stock require higher return than growth stock compared to with similar level of market risk. So here positive value beta is indicate value stock, represent value stock. Okay, so for this Pharma French model, what you need to understand is, okay, of course, you need to be able to apply the model to estimate the required return. And you need to be able to, identify, given the beta, the market beta, the size beta, and the value beta, you must be able to explain the characteristic of the company, whether the company has below average or above that average market risk, whether the company is a small cap stock or a big cap stock. Small cap stock will have positive beta. Whether the company is a growth stock or value stock, right? Value stock will have positive beta, right? Okay, so let's look at this example to give you more understanding. Okay, this is from the textbook. Okay, so from these are the models when they run the output from the regression, which will become the inputs of the Pharma French model. Okay, so model A is this just a single factor model that take into consideration only the market risk. So this is to be plugged in CAPM, right? And this is the regression, the multi-factors model, regression that run from the multi-factors model. So it include market risk, the small minus big, the size, right? And the value, right? Value. So they have, in addition to the equity risk premium, they also run the model against the size premium, right? Small cap minus the return from small cap stock minus big cap stock, and the value premium is the return of value stock over growth stock, and have the beta. Okay, so I want you to notice that with different model, you can see that the beta for market risk premium differ because it's different model, right? This is the market beta. which between the two models is not the same number. Okay, the model, since model B integrate more factors to run to the regression model. Okay, so from this, okay, they ask you to estimate. So this is actually Microsoft. So they asked you to estimate Microsoft cost of equity using the CAPM and the cost of equity using Pharma French. So to use CAPM, we look at model A, right, to plug in the number. And based on Pharma French, we look at model B and you plug in number. And you need, so this is the first learning outcome, right? Just you must be able to use this input to plug in the model, the appropriate model to estimate the required return. And the second learning outcome, you must be able to explain the characteristic of the stock given this data, right? And here it said that Microsoft, it is a large cap growth stock. Why is that? Want to answer me? Why Microsoft, based on this data, why Microsoft is a large cap growth stock? พัตะวันค่ะ
Because it has negative beta for the size beta, so it means it is large cap stock. And for the value beta, it is negative, so it is growth stock.
Okay,ค่ะ. And may I ask you, your other friends, is Microsoft and above average market risk or below average market risk? Who want to answer me? For Microsoft, it is a above average market risk company or below average market risk company? Shuti Ponค่ะ
This is below average market risk ครับผม because the beta from the Pharma French is lower than the beta from CAPM.
When we want to determine whether, if it's a small cap, big cap, we look at the, just say whether it is a small cap or big cap, we look at the size beta, right? And we know that if the size beta is positive, it is a small cap. If it is negative, it is large cap. So in this case, it is a large cap. So if we want to look to determine whether the company is above or below average market beta, so what beta that we look at? What number here in here? So what should we look at? May one.
Is it number 2?
Right, number 2. So we look at this number to determine whether the company is above or below average market risk. And in this case, and we know that for the average number, the market risk is this one, right? And from this, so Mayawan, do you want to try to answer me whether the company has above or below average?
So it's above because the market beta is 1.
Right. And this number are higher than 1, right? So it is above average market risk. Okay. For the market beta, it is more higher than 1 or lower than 1. Normally it's in the same direction, so it is not negative. Okay, so it can be 0. As I shown you, it is shown here in this chart, right? So this is below average market risk, right? It is below 1, but it's not negative. And this is it can actually mathematically it can be negative, but in the real world, if it's negative, it means the return is in an opposite direction. But in the real world, normally it's the same direction, but just lower or higher. All right. So this is the market beta. If it is 1, this is the average value. But above average risk, higher than 1, below average risk, lower than 1. But for the size and the value, beta is positive and negative. Okay.
And can I ask a question, Kap?
Ah.
Why in the real world would there not be negative? Like, why would it not be negative?
For the market beta, right?
Yeah.
Yeah, because like if you look at the actually what is market beta? Market beta, it is from the beginning that I explained to you, right? That when you when companies combine into market portfolio, there are two parts of risk. The first part, it is the diversifiable risk that can be diversified away. So the remaining level of risk, it is the systematic risk and diversifiable risk. So this undiversifiable risk, theoretically, by definition, is supposed to be positive, right? Because it's the remaining risk that cannot be diversified. And the number average into the market risk, which is the average value. Some company has lower level than the market, but it's still the remaining risk, so it's positive. Some company has higher level of risk, right? So it's higher than one and lower than one. So this is like by the understanding of the risk. But model wise, right? Model wise, you run when you run a regression, if the return of the stock and the market totally, if it's like always mostly on an opposite direction, right? In this case, it can be negative, but from my experience, I cannot find any actually.
Great. Thank you.
Okay. So now we finished pharma French, right? And the next model to estimate the required return on a stock, the cost of equity, it is a build-up model. Okay, so what is build-up model? Build-up models actually is the different of the build-up model from the CAPM or the multi-factor model is that the build-up model doesn't take into account the beta. It's just to add up the risk into the risk-free rate. Okay, so for the build-up model, they just add up the risk premium to the risk-free rate without multiplying the risk premium by beta. And the one that more frequently used under the build-up model is this so-called bond yield plus risk premium. And this bond yield plus risk premium, when we talk about bond yield, is this not the risk-free rate? Is this the yield to maturities of the company long-term debt? So when you want to estimate a company cost of equity, you can look at the cost of debt of the company, because like this yield to maturity of the company long-term debt is supposed to reflect the cost of debt of a company. And we know that equity supposed to be, has higher risk than debt, right? Because of the debt has higher claim compared to shareholder. Shareholder is the residual claim, right? So equity is riskier than debt. So from the cost of debt of the company, we add risk premium to reflect equity risk. Okay, and typically the risk premium that is added to the cost of debt to the yield to maturity is about 3 to 4%. Okay, so actually, like this model, if you find trouble in estimating the cost of equity through the CAPM model, because of maybe like thinly traded company or public company and so on, another option to estimate the cost of equity, if you don't want to estimate the unlevered beta, pure business beta, which is quite complicated. Another more practical approach and more understandable approach is, you can just use this one, bond yield plus risk premium. So you just, because, and for me, myself, I think this one is kind of, quite valid, because when you look at the yield to maturity of the company, it reflects the market value, right? The yield to maturity is from the market, and if we suppose that the market reflects the current cost of debt, the current cost of debt of the company, so it's quite valid in terms of the yield to maturities, and you add the equity risk premium to it. Okay, so I think it's just this model is also justified, especially like for private company, that you might, it's maybe complicated, or if the company that you cannot find comparable firm to estimate beta through like unlevered beta approach. Okay. Okay, so until this slide, any question? Okay, so if you don't have question, so this is the end of the estimation of the cost of equity, right? To approach CAPM, Pharma French, the build so Pharma French under multi-factors and the build-up model. Okay, so the next topic we're gonna talk about the estimation of the cost of debt and the weighted average cost of capital. So let me share you the next slide. All right. So we are going to discuss to learn the estimation of the cost of debt to different approach based on different circumstance, and the estimation of the WACC, the weighted average cost of capital. So for the cost of debt, okay, so this slide, the point that I want to highlight is that, okay, the first point is the cost of debt is the current cost. Okay, current cost means if a company want to borrow now, what will be the cost? It's actually it might not the totally right when I say now. Actually, when I say current cost, is this the cost? For example, if you want to value a project, right? So the cost of debt supposed to be the cost of debt that the company can borrow to finance that project. So that's the cost of debt, like in capital budgeting, right? In equity, the cost of debt means the interest cost that the company can borrow now, the current cost, to support its future operation on an going concern basis. So that's the cost of debt, right? So is this supposed to be current cost, not historical cost, right? And the other point that I want to explain is that, okay, here, actually, is this the same concept when we talk about the component of return from the beginning, right? So every expected return, there are two components, the risk-free rate and the risk premium, to compensate the risk in addition to risk-free asset. Okay, so in this case, is this that, so the risk premium that we add is this the default risk premium. So the cost of debt is basically it is the risk-free rate plus default risk premium, right? When we want to estimate cost of equity, it is risk-free rate plus equity risk premium, right? And we can adjust by company with the beta, right? The cost of debt is just the risk-free rate plus default risk premium. So that's it. That's the very fundamental concept. Okay. And however, there are three circumstances that you can come up with the cost of debt. Okay. So the first situation is if the firm that you want to estimate the cost of debt has debentures outstanding that are actively traded, in the secondary market. So when the company bonds or in Thailand we call it debentures, when a company debentures actively trade in the secondary market, you can look at the yield to maturities. So what is the yield to maturity? What is the difference between yield to maturities and coupon rate? Any student have knowledge on this and want to share to the class? What is the difference between yield to maturity and coupon rate of the debentures? Chayut ค่ะ
So I think yield to maturity is like the total yield or the total return as a percentage that you will gain. But while the coupon rate is just like the percentage of the coupon that you will gain each period.
And what is when you say the total yield, what is the total yield?
So it's like the total return when like you compare, you discount the future value back to present value. So it's like you have also capital gain plus coupon.
But if you, actually this say yield to maturity, right? So actually by wording is you're supposed to hold it until maturity. And if you hold a debt to maturity, we will have any capital gain.
No, sorry.
Okay, maybe.
I just mean like.
Yeah.
Yeah,
So
maybe
what
let
do
my
you
friend
mean?
answer.
Sorry? So any student want to answer? Chayanit ka. What is the difference between yield to maturities and coupon rate?
I think yield to maturity is basically the sum of the coupon rate together.
It is what?
It's the sum of the coupon rate, and so when you put it in percentage, it's a sum of a coupon and to the total price of the bond.
Yeah, still not quite. Okay, it's closer. Okay, Kelvin, do you want to try?
I think that for the yield to maturity, it is the return that we would realize if we hold that particular bond until maturity.
Okay, is this the return? If
this is the rate of return, yeah.
It's the rate of return if we hold the bond until maturity.
Yes.
And why it's different from the coupon rate? Why it is different from the coupon rate?
Because the coupon rate is the rate that is stated on the bonds itself. So you would know actually you would earn what percentage that you would earn, what particular baht or dollar you would earn. Yeah.
So coupon rate is this what you will earn from the par value of the debt, right?
Yeah.
And what makes yield to maturity differ from the coupon rate? Maybe I saw a lot of students raise your hand. Nashanan ka.
So the major difference is that coupon rate has fixed bond amount throughout the year, but for the yield of maturity, it changes depending on many factors like the remaining years that have until maturity and the current price that the bond is being traded.
Okay, I will let Metawi answer also because I saw you raise your hand. Metawi, you want to add anything?
Yeah, I think the difference between the yield to maturity and the coupon rate is that the yield to maturity would also include the difference between the face value and the current trading price.
Okay. Actually, you try to answer and it's kind of close, right? But actually the point that I want to make here is that, coupon rate, is this the promised return on when you buy the debentures at, the debenture actually, the debenture has par value, right? And the coupon, right? So that's the features of the paper. Is the promised return based on the par value, right? Coupon is quote on the par value. So if, for example, if the debentures has 3% coupon rate, you will have 3% out of the par value that when you buy the debentures at par value. Okay, but so that's the coupon rate. For example, if a company issued that debenture 5 years ago during the high inflation, during like the high inflation period, right? 5 years ago when inflation rate is so high, economic risk will be high. So in that case, the company might need to when the company decide to issue a debt paper during that time 5 years ago, high inflationary pressure, the coupon must be high, right, to reflect that risk. Okay, but when time passed, that coupon, that company debt, suppose it has triple B rated, right? Triple B rated 5 years ago, investor may require a return of 4% from a triple B, from maybe 6% from a triple B rated bond because of high inflation and so on. Okay, but when time passed, let's say 3 years later, the risk of the company itself become lower. The risk of triple B rated company become lower, inflation lower. So investor may require, in this case, investor will, for triple B rate bond, investor will not require 6% anymore because of the lower risk, right? 3 years later, like 5 years ago, for triple B rate bond, require rate of return, investor requires 6% because of the risk at that time, right? But 3 years later, now 2 year remaining time to maturity, 2 years later, lower level of risk, triple B rate bond, required rate of return may decline to only 4%, right? So in this case, what will happen to the bond price compared to the par value? 5 years later, a company issue a bond, right? Par value 1,000. Investor required return is 6%, so the coupon must be 6% on 1,000 5 years ago. But when 3 years later, 2 years time to maturity, when risk level lower, required return on triple B rate bond is only 4%. Investor investing in this bond now want a return of only 2%, 4%, but this bond promised coupon is 6%. This bond, this triple B rate bond issued by company A, promised yield is 6%, but you require return from your investment of only 4%. For what? So in this case, what will happen to the market price of the bond? So who want to answer me? I saw Nashanan, you raised your hand very long time. You still want to answer, or you want to answer this question, Nashanan?
So the bond will be traded at lower price.
This bond offers 6% coupon rate. But so it means if you invest in the bond at 1,000 at par value, you will receive 6% return, right? But since you require only 4%, what will happen to the bond price? So what is your answer, Nashanan?
So the bond will be traded at higher price.
Why is that?
Because now the required rate of return is lower.
Right. So like, okay, if you invest at par value, you will receive 6% return, right? Which is higher than what you expect. So you're willing to pay more, right? So in a common sense, right? You're willing to pay more, the price is higher. Or if we want to explain theoretically, when we talk about 4%, the required rate of return of in the market actually it is the discount rate, right? When you say, okay, the required rate of return is supposed to reflect the risk of the cash flow. The coupon is the cash flow that investor will receive, and the required return is the discount rate that discount the cash flow to the price, to the present value, which is the price. So um, lower discount rate, right? Lower required return, 4% versus 6%, higher price, higher present value. So this required return is this yield to maturity, right? So yield to maturity reflects current required return, current cost, while the coupon rate is reflects historical cost, right? And we know that cost of debt is must be the current cost, the cost that, okay, like this, in this 3 years later, if a company want to, this company triple B rated, if the company want to borrow by issuing debt, the company will pay only 4%. So is this the current cost, right? So if a company has bond outstanding that are widely traded, the bond might issue 5 years ago, but 3 years later it's traded in the secondary market, right? The price will be higher to reflect the required return of only 4% to reflect this due to maturity. So if the bond is widely traded in the secondary market, you can simply look at the yield to maturity. So this yield to maturity is the required return at that time, the current cost, right? And the yield to maturity is provided by the data source, of course, the Bloomberg, which is the most popular source that the practitioner use, right? So you can just look at the Bloomberg terminal and find yield to maturity of the long-term bond of the company that is actively traded. Okay, so this is the first scenario. Very simple. Look at yield to maturity because it reflects current cost, reflects the current required return of the investor. The second scenario, if a company have bond outstanding, but the bond might not trade in the secondary market, or if it is listed in the secondary market, but if it is illiquid, right? If the bond is illiquidly traded in the secondary market, similar to when you estimate the beta, if the price, stock price is illiquid. So the data may not be useful. If the bond is traded, but this is illiquid, or if it's not listed at all, like private company, so you cannot look at the yield to maturity in the secondary market. So what you need to do is to estimate the yield to maturity based on comparable debt, right? But this one is easier because debt has credit rating, right? So you can just simply look at another company with the same credit rating as your company, as the company that you want to analyze. For example, if your company to analyze is rated triple B minus, right? So, but the debt is not actively traded. So you look at some other company with triple B minus rated bond, the same time to maturity, and you have the yield of that company, triple B minus rate bond, to reflect the cost of debt of the company that you analyze. So this is the second scenario. And the third scenario, for a company with no debt, no debenture at all, the company may have only bank borrowing, right? No debt paper that is issued by the company. So in this case, you need to try to estimate the cost of debt for this company by so-called synthetic rating, because the company has no debt paper, so it has no debt rating, right? So you need to try to estimate the credit rating for the company by from the financial ratio. I will tell you later, okay, and to come up with the cost of debt. But if it's lucky that the company just borrow from a bank, you can refer to that cost, right? Because we say, okay, the cost of debt, this is the current cost. So if the company has borrowing from a bank, but the company borrow maybe 10 years ago. So that might not be relevant because the interest rate that the bank charged to the company 10 years ago might not reflect the current rates of the company. But if this company just borrow from the bank and you know what rate that the bank charged the company, you can use that as the cost of debt. Okay, so 3 scenario to estimate the cost of debt. And I go to details. Okay, actually I explained a bit, quite a lot here in the slide, but okay, there are more details. Okay, so the first scenario, a company with long-term bond outstanding that are actively traded in the stock market. We use the yield to maturity as the to represent the cost of debt, because the yield to maturity is actually the required return that investor require from investing in that debt at that moment. Okay, so yield to maturity is different from a coupon rate. Coupon rate, it is the interest rate that is stated on the paper, right? So it's historical, as I already explained to you before, it's historical cost. But yield to maturity reflects current cost, right? So it is basically the discount rate that discount the cash flow of the debt. Coupon rate is represent cash flow, right? So for example, if you invest in a debt paper with 3 years time to maturity, right? So in the next year you will receive coupon, the next 2 years after you receive coupon, and the last year in year 3 you will receive coupon and the par value back. So when you discount this cash flow by the required return, you will have the price of the debentures, and this required return basically it is the yield to maturity, so it's the cost of debt. Okay, it's coupon, it is the cash flow, it is the promised return. It's the historical cost, but yield to maturity is current cost. This is the cost of debt. Okay, so just to check your understanding, very simple example here. Find the yield to maturity of 1,000 par value, 3 years time to maturity, 10% coupon. Okay, when I talk about time to maturity, right, 3-year time to maturity, time to maturity is the remaining time until maturity. But the example that I just discussed with you, like the company issued debenture 5 years ago, but 3 years later, right, the cost of debt fall from 6% to 4% 3 years later. So it means time to maturity is this 2 years. So that's the remaining time to maturity is this a remaining time until maturity. Okay, so and when we look at the yield, we look at yield to maturity. And example, if a company wants to issue a debt with will mature in 4 years, and the company wants to look at the cost of debt, it needs to be matched with another debt yield to maturity of another company with 4 years time to maturity. Okay, so the yield to maturity and the time to maturity reflects the current situation. Okay, and here in this slide, find the yield to maturity of 1,000 par value, 3 years, 10% coupon debentures at the following market price. So you don't need to calculate. Actually, you can calculate using your knowledge about time value of money, right? Because yield to maturity basically is the discount rate that discount the coupon to the price, right? So this is so you can set this as a present value. You estimate the coupon 20% of 1,000 par, and you try and error, or you use the financial calculator to calculate the discount rate that discount the coupon to the coupon and the par value at the terminal year, right? To the price. But in this one, you don't need to come up with the number. I will ask you whether in each of this case, whether the cost of debt will be yield to maturity, the cost of debt will be higher or lower or equal to 10%. Okay, so you can just answer me at this price, the cost of debt will be higher, lower, or equal to 10% at this price. So any student want to answer me? ชุติพลค่ะ
Okay, so the first one, I think that the yield to maturity should be lower than the 10%, because the investor would require the would basically they would need to have to be able to buy the bond at the lower price in order to like realize the yield to maturity.
Again, can you rethink about your answer and like answer more slowly and try to think about the logic behind your answer.
So
okay, let's see. This bond 1,000 par value offered 10% coupon rate, right? If you invest at par value, you will receive 10% return, right? But now you will invest in that bond at only the price. You will be able to invest in this bond at the price below par. You will not to pay 1,000 to own this bond. You will pay, the market price now is lower. You will pay only this price to own this bond and earn 10% on 1,000. So what will be the return that you will receive? That reflects the required rate of return.
Okay. So the yield to maturity should be higher than 10%, because you can buy it at the lower price, but you can still gain the coupon rate of 10% at par value.
Right. Yeah. And if you think about the theory, right, this is the present value of the cash flow, right? Lower present value, higher discount rate. Discount rate is the yield, the yield, the cost of debt. Higher discount rate, lower present value. So in this case, the answer is higher than 10. And this one is very easy. who want to answer me? ชุติพันธ์ค่ะ number B ค่ะ the yield to maturity.
I already answered that.
Oh, you already answered. So พันค่ะ do you want to answer question B?
I think it's gonna be lower than the return gonna be lower than 10% because
the cost of debt, right? The return.
Yeah, it is higher since we purchased the bond as a premium. I think that the option B, the return is gonna be lower than 10% during the 3 years.
Right. Okay. And the last one, who's gonna answer this one? Is like bonus bonus question. Any student? ธรรมโชติค่ะ
So it will be equal to 10% because the price is equal to the face value.
Okay, thank you. Okay, so the first scenario, cost of debt, if the debt is widely traded in the secondary market, you will know the price. And actually, like in Bloomberg, they not only quote the price, they also quote the yield. You don't need to estimate the yield by yourself, right? You don't need to find the discount rate that discount the cash flow to the price, because they already disclose the yield. So basically that yield to maturity is the cost of debt. Okay, and here this is the example from the textbook, the McKinsey one. Okay, you can see that this is the trading of the Home Depot. Home Depot for the debenture that is issued in 2036, BBB plus rating. And these are the transaction. Here they disclose the price, right, and the yield, right? But here you can see that with different transaction, different yield. So now the problem is what yield you are going to use, right, as a cost of debt, right? And so again, in valuation, in finance, it's both there is no rule of thumb, right? You need to use adjustment, right? So when I say that we use the yield to maturity to reflect the cost of debt, so it's automatically assumed that we believe that the market is efficient, right? Actually, if the market for this bond is efficient, the price should be the same for all transaction, right? Because it's efficient. Because actually, fundamental or the risk of the bond shouldn't change within a minute or within a day or a minute, a second, right? So it should be the same. But since actually there are buy and sell, so the price can be volatile just a bit. So they suggest that the assumption is that you assume that the market is efficient, right? But since there are still some different, it suggests that you should look at the transaction with high volume, right? Because some transaction with very low volume, so it's maybe some trader, there can be some manipulation or it's not reflex, right? So use the one with high volume. Okay, so the one that I put a blue box here. For me, I'm not know. Maybe I might average the number. It's quite close, right? You can see that it is quite close. Maybe I want to average number or just use the number with the highest volume. So it depends on your judgment and the reason to support why you choose it, right? Okay, so this is the example, and this one actually this Home Depot issue still trade right now. This is I just look at since I don't subscribe to Bloomberg, so this is from supposed to be investing.com, and but they didn't disclose the yield. Is just the price, and you can see and you can notice, right? This one, Home Depot, BBB rated issue like long time ago, 2036. The coupon rate, it is 5.875, which is quite high compared to BBB rate bond, to the return that you can receive from a BBB rated bond at this moment. Now a day for BBB rated bond, I guess you will receive about 3.5. Yeah, I think 3.5 to at maximum no more than 4% for BBB rate bond. But since this has been issued long time ago, it's but still it's very long date bond in the US. The bond seem to be the maturity of the bond seem to be a lot longer than the bond issued in Thailand. In Thailand, normally, like for most corporate, they issue 3 years. Like for me myself, I prefer to invest in the bond with time to maturity about 3 years, maximum 4-5 years. I don't like wait so the long date, the long time to maturity bond. This is my personal preference, and I think many investors do. So we don't have many of the very long term bond, except for the government bond. All right, but okay, come back to this Home Depot. BBB rate offer very high coupon. Right? So what's supposed to happen to the price of Home Depot right now compared to par value? What's supposed to be the price of Home Depot bond right now compared to the par value? So who want to answer me? If I want you to guess what is the price of Home Depot bond, debenture, this issue of debenture right now compared to par value, do you think it will be higher or lower? Athawut ka.
Since you say that this rating bond usually now have only around no more than 4%, and this bond is offering the coupon of over almost 6%, I guess that the price must be higher.
Yeah. Okay. And if you
past.
look, okay, thank you, Ka. Yeah, because if you look at this is the actual number. I just look at the data last year, the end of last year. So you can see that the price of Home Depot right now, it is a lot higher than par value. Is traded about 148% of the par value, right? Because of the fact that the promised coupon long time ago, that promised as a on par value is high, right? And so this one we can is support this is the real number, the actual number is support theory, and it's also support the fact that we discussed earlier that the trend of interest rate, when I show you the discount rate chart, right? The risk-free rate of the Thailand, if you recall the chart, the chart that when I discussed the risk premium, right, and I show you the chart that show you the risk level of risk-free rate over time, and this is a downtrend, right? Interest rate around during the past 3 decades is on a downward trend, and I also discussed with you the reason, right? My thought on that, yeah, and it's represent, right, because now interest rate for triple B rate a lot lower than the past four number. Okay, and this is like the Bloomberg terminal. Also, you can also look at yield price and so on to find the cost of debt. Okay, the second scenario, if the bond is if a company has a bond, right, is issued its own debenture with credit rating. Actually, like when a company any company to issue a debenture, I don't know, maybe I don't know if you kind of confused about the wording debentures and bond. If we want to strict with the definition, the bond supposed to be the debt paper issued by a company, long-term debt paper issued by a company with collateral. Yeah. And when we say government bond, right? When we talk about government, it's government bond because it's when we say government is seem to be guaranteed by the government. So it's we call it government bond. But for corporate, normally for corporate we refer to as a debenture. But sometimes people say corporate bond, but actually bond supposed to have collateral. Theoretically, by definition, debentures no collateral. Okay, so if you want to stick with the definition, in Thailand, when company issue a debt paper, long-term debt paper is no collateral, so we should call it debenture. Okay, so when a company and when company issue a debentures long-term debt paper, right? So we have bill and debentures, right? If it bill or note, it is short-term, right? But if it's a debenture, it is long-term. When when companies are to issue debentures, it is required by the supervisory body, that is the Security Exchange Commission, SEC. This is the Security Exchange Commission, SEC in Thailand. Is this the คณะกรรมการกำกับหลักทรัพย์และตลาดหลักทรัพย์ กลต. This is the supervisory body of the capital market long-term financial instrument. It is required by the supervisory body that a company that will issue debenture is need to be rated. That the debenture need to have rating, credit rating, unless it cannot be issued, right? So for a company that has debenture supposed to have a credit rating. So if that debentures are issued by a company, is issued by the company, but is not actively traded in the secondary market, but it has credit rating, right? So you can estimate the cost of debt for the company by look at the yield to maturity of the other company with the same credit rating. So that's it, right? So given the credit rating, you can refer to yield to maturity of the other company with the same credit rating. And you have a choice to look at yield to maturity or default premium or credit spread or credit default swap. So if you look at the yield to maturity, you don't need to to work more, right? So the due to maturity, basically the cost of debt. But if you use the default premium here, right? So we know that the cost of debt this is the risk-free rate, right? Supposed to be the yield, the return of T-bill. Now we talk about debt paper, it's not equity, so the risk-free rate is the return on short-term government debt, which is the treasury bill, right? So this is the risk-free rate plus default premium. Okay, so this is, if you look at the default premium for the given credit rating, you need to add this default premium to the T-bill rate, right? To the risk-free rate. And there are also data available on credit spread. So the difference between credit spread and default premium is that, okay, default premium is the difference between the yield of risk asset, the debt, right? The risky debt over the risk-free rate. This is the default premium. While the credit spread or the yield spread, it is the difference between the yield of different paper, similar maturity but different credit rating. Okay, for example, the credit spread between 5-year AAA rated bond and BBB rated bond. So it's the different, same maturity but different in terms of credit rating. Okay, default premium is the premium over risk-free rate. Credit spread, it is the different spread between different credit rating papers with that has similar maturity. It can be credit spread between BBB rate and AA rate, or BBB plus rate and BBB rate, and so on. Right, that's the credit spread. Okay, and the other, so you need to understand the definition. So then, after you have the number, you can make appropriate further estimation to come up with a huge maturity. Right, and the credit default swap. What is this? The credit default swap, it is the contract that the seller of the credit default swap promised to compensate the buyer in the event that debt is default. So the credit default swap. So the price of the credit default swap is supposed to reflect the risk of the debt. Right, the debt default, the probability of the debt before the risk of the debt, right? So that's are the given the credit rating, you can look at different different pricing, or different yield, different premium, and to estimate your cost of debt of the company that you want to analyze. Okay, so for example, here this is the this is the yield. So the yield based on credit rating, right? The lower the rating, the higher the yield, right? The higher the risk, the higher the cost of debt, the yield. Okay, so this is the treasury. This is the risk-free rate, and the default premium is the difference between the yield of the risk asset, the debt, and the risk-free rate. Right? This is the risk rate, and you can also estimate the credit spread between different rating, but the same time to maturity. Okay. So until this slide, any question? Okay, if you don't have question, so this is actually supposed to be your own responsibility to study on the rating mechanism, or this is like the credit rating, right? This is high rated and low rated. Below BBB is this speculative bond, and is the below investment graded bond. So and above BBB it is investment grade, over risk. So the first scenario, the second scenario, the third scenario, The third scenario is for a company with no debt paper issue, right? A company that doesn't issue any debt paper, so no credit rating. So in this case, you need to estimate the credit rating for a company by yourself. Okay. In the case that the company has recent borrowing history, as I explained before, you can look at that the recent cost. But if the company borrowed long time ago, that's historical cost. You cannot refer to that as the cost of debt. You need to try to estimate a credit rating for a company. So it's called synthetic rating. Okay. So synthetic rating is the approach to come up with a credit rating of the company based on financial ratio. Okay, and the most common ratio that we use, it is the interest coverage ratio. So any student remember the formula for interest coverage ratio? I want to tell the class, what is the formula for interest coverage ratio? Any student? You're supposed to learn this from your very beginning year. The formula for interest coverage ratio. Yeah.
Is it EBIT divided by interest expense ค่ะ
EBIT divided by interest expense. Yeah, actually, like I kind of thank you, Haruya. I kind of surprised like that. You don't remember the formula because it's quite. If you when I teach, actually, it's lucky for you that the course is online, the exam is online, so it is an open book. So you can short note the formula, but if this is on campus, I never allow you to short note the formula. You need to remember, and we will be able to remember the formula if you understand the logic behind it. And like interest coverage ratio, the logic is very simple, right? You want the interest coverage ratio is measure a company ability to pay the interest, right? Interest coverage. Does a company have enough ability or the level of the ability to pay interest, right? Capability of the company. And why is this EBIT divided by interest, right? Because if you look at a company income statement, right? Claims, right? Claims from sales, cost of sale, you have gross profit. From sales, the first claim is the supplier, right? Suppliers claim for the cost of goods sold. You have gross profit. From the gross profit, the claims are like employee and so on, the SG&A, right? And you have EBIT, operating profit, right? Operating profit from EBIT, earnings before interest and tax. EBIT, operating profit. Who is the next claim? And EBIT, earnings before interest and tax. The next claim over EBIT is this debtor in terms of interest, right? So we want to know whether a company has enough EBIT to pay interest or not. The higher the level of interest coverage ratio, which is EBIT over interest expense, the more ability of the company to pay the interest, the less riskier of the company. So the higher the ratio, the higher the rating. And this is kind of the map of the rating provided by this the textbook Damodaran, which is published in 2012, which is quite a long time ago. This ratio can change over time. And even in this textbook, there are ratio for larger market cap company here, right? And for smaller market cap, in order to gain, like for example, triple B rate is require higher ratio to get to be justified for triple B ratio. So the ratio can differ across the size, the region, or over time, right? So if you want to do this at work, right? So simply you can, if you want to come up with synthetic rating for one company, you should try to look at other company with similar level of you should try to look at other company with debt paper and credit rating and have about the interest coverage ratio in the same range as the company that you estimate, right? For example, if your company that you want to synthesize the rating, you estimate the interest coverage ratio at 4, right? And then you should try to look at other company with debt issue with interest coverage at 4. What is the rating? So that's how to do it, right? How you do it. Okay, so this is the synthetic rating based on interest mapping of the interest coverage ratio. Okay, and the other. So any question on this slide? Okay, so if you have no question, the other ratio is this so-called Z-score. Z-score apply quite a lot to measure credit rating of financial company like bank or finance firm. Okay, so like for real sector, you can use interest coverage ratio and Z-score, but for financial sector, they use Z-score quite a lot. And for Z-score, for financial sector, there are more some other details as well, because like the financial statement of financial sector is not similar as the real sector. But anyway, like if you work at a bank and you want to determine credit of a bank or financial institution, they use Z-score quite a lot. Okay, and this for real sector, so how to estimate this Z-score. The Z-score actually is this developed by the professor at NYU. Okay, we can also call Edward Affman's ratio, Z-score ratio. Okay, so this form, and it has been proved that it has kind of prediction power on credit rating. Okay, so based on this ratio, you plug in, given this formula, you will have a Z-score. And this model proposed by Affman in 1968, and this is the Z-score that proposed that if Z-score is higher than 2.99 in the safe zone, between this is this gray zone. If it's below 1.8, is this threshold. This is like high, very high, like probability of default. But anyway, the score changed over time again. Okay. Actually, I believe this professor, he has his own page and he published the score from time to time. You can map the score. Okay, and this is like the ratio later. Like for triple B, what should be the Z-score ratio? And the higher the ratio, the higher the score, the better the rating. Okay. And this is the example of synthetic rating based on Z-score. So basically, given the number, the ratio, you plug in, right? You have the score, okay, and you map with this 6.9 is quite high. It's very high, so it's AAA rate. And for AAA rate bond, you can look at so this is the default rate. This for the AAA rated is 69 basis points. So basically, you can add this 69 basis point default spread to the risk-free rate to come up with the cost of debt. So this is basically how to apply the synthetic rating to come up with the cost of debt. Okay, so any question? Okay, so if you don't have question, actually, if we finish the topics quite fast, so I have, oh, sorry, not finished yet. So, so it's the WAC, right? The WAC is very simple, right? So I just thought we already finished. Okay, so after you have now you can estimate the cost of equity, the cost of debt, right? And you can from the component cost, right? Equity cost, debt cost, you can now come up. If you want to value the project or a firm, you can estimate the weighted average cost of capital, right? By given each of the component costs, cost of equity, cost of debt, to plug into the model to estimate the weighted average cost of capital, the cost of debt must be the cost of debt after tax. So after you have the cost of debt, right, based on what we learned, right, the cost of debt is pre-tax. You must multiply that by 1 minus tax rate to come up with cost of debt after tax. Why is that? It is because the interest expense on debt, right? The interest on debt is tax deductible expense, is the provide tax shield benefit. So it's automatically lower the cost of the company because the company pay less tax given the interest that it pay, right? So it's provide tax shield benefit. So is when you calculate weighted average cost of capital. So the benefit of the issuing a debt is to lower the company tax payments. So it's kind of imply lower cost. So you must multiply it by 1 minus tax rate. Okay, so after you are able to estimate each of the component costs, right? So this is the cost of equity. This is the cost of debt after tax, right? So you average it to the weighted average cost of capital by the value, the market value weighted, right? So you weight each of the component costs by the market value weighted. So this is the total market value of debt and equity, right? And this is the market value of debt over total value. This is the market value of equity over total value. And why you use the market value weight, not the book weight? Is this because, again, right, you want to look at current cost and market value, not the book or the par value that represent current cost. Is this the market value that imply that reflects the current cost, right? Because we know that the cost of any instrument is the discount rate that discount the cash flow of that instrument to the market value, to the price, right? The price is the market value. It is not the book value or the par value. That's the historical cost. So that's why we need to use market value, right? So it's market value weighted average. So the WACC basically is the market value weighted average cost. So that's it. Okay. Any question on the WACC formula? I think you already learned WACC formula many times, but I want to point out like the understanding of the formula, why it is market value and so on. Okay. And this is the example of how to estimate the WACC given. This one is just a plug-in, very simple, right? So you have risk-free rate, equity risk premium, beta. With this, you can use cap M to come up with the cost of equity. And you have yield to maturity of long-term bonds. So this is the cost of debt. And they already give you the long-term debt to capital at market value. So this is the market value weight. So debt to total capital, it is 40%. So equity weight, it is the remaining 60%. Now we assume only debt and common equity, right? If a company has other instrument as part of its capital, for example, preferred stock or some other like complicated instrument, you must try to find the cost of that instrument So basically, cost of any instrument is discount rate that discount the cash flow of that instrument to the present value. So that's it, right? So you need, if the company has some other instrument as part of its capital, apart from just debt and common equity, you need to consider it as well, right? But in our class, we will focus only on common equity and debt, right? So that's the rate, right? Already given debt 40%, equity 60%. So you just plug in the number, and you have answer for the weighted average cost of capital. So it's the cost to raise each of capital with this mix, right? 40% debt and 60% equity. And this example, it is from your vacancy textbook. So they provide you with the market value weight of debt and equity, the cost of capital, each of the component costs, and this is the tax rate, right? Marginal tax rate. The cost of debt must be after tax, right? So you multiply this cost of debt by 1 minus this 37.6%. And so you have, this is the cost of debt after tax. This is the cost of equity. You multiply cost of debt after tax by the weight of debt. So you have contribution from debt is 1.3, and contribution from equity, the cost of equity multiplied by the weight. You have the contribution from equity combined to total weighted average cost of capital. Okay, so this is the WACC. Okay, so this is all about how to estimate the cost of capital, the cost of equity, the cost of debt, and the average cost of capital. All right. So we finished this quite fast. We have one remaining time. So here, this is the we have no assignments for today, but I've already posted one interesting YouTube video. It's about Goldman Sachs discussion on their equity risk premium estimation, and I already post on July Backboard that YouTube, and the key question for you to try to think about is 7 questions that I post in there, and select question from that list will be either in the quiz or the midterm exam. So make sure that you listen to that YouTube and be able to answer all these questions by yourself, okay? Because it will be on the quiz and the midterm exam. Actually, I plan to include in both the quiz and the midterm exam. So please make sure that you listen to it, because it is quite interesting, and it's like the practical way that they use theory and how they thought about it and so on. Is very useful for you, I think. Okay, so please listen to that and be prepared for the quiz, which will be, the quiz will include this topic, right? The cost of capital, and the next topic that we're going to learn, the economic profit and residual income valuation. It will be included in the quiz, which will be on the 4th of February. Okay, so please look at that YouTube. And the end chapter exercise, this is from the textbook. So this is self-study, okay? And it also, the question from this question, select question from this will also be in the quiz. So make sure that you understand. So I will have a break. Now it's 6:30. So I will, I don't know, if maybe you have only short break and we can, finish early. So I still allow you to have only 10 minutes break. We come up 6:40, and then I will discuss some of the questions from the end chapter exercise. All right. And after that, we will finish the class. All right. So now it's 6:30. I will have 10 minutes break. Come again at 6:40. Here's the one that I just mentioned about Goldman Sachs YouTube on equity risk premium. Okay, so for any of you who haven't take a look at it in the on the blackboard yet. So these are what I talk about. So please try to find it on blackboard and try to answer all the question. It will be included in the quiz and the final exam, right? And now we're gonna discuss the end chapter exercise. So I will select just some few questions to discuss with you. The question that I think I want, because some maybe you need explanation, right? Okay, actually this one is very easy. Because I already explained earlier in this today class. Right? So this one, they give you the factor sensitivity and the risk premium on market factors, size factors, value factors. So basically, this is Pharma French inputs of the Pharma French model. Okay, to estimate the cost of equity, you can plug in the number by yourself, right? Question B, they ask you to describe the X-style characteristic that refer to level of market risk, large or small cap, growth stock or value stock of this company. So who want to answer me? So very easy actually, because we already just discussed this not a long time before this in the class. Any student want to answer me? Given this input of the company, so please tell me whether this company is, above or below market risk, large or small cap, or growth stock or value stock. Are you still with me? อัธวุฒิค่ะ
Okay, because the factor is negative for both the size factor and the value factor, this means that the size is large, and the value factor is it is well, this value. I mean it's growth, it's growth.
It's growth stock, and
Yes.
if it's and is this company above large cap growth stock, and is it above average or below average market risk?
Above average, because the
Above
market
average.
factor is more than one.
Okay, thank you. Okay, very easy one. The next one. Okay, so this one. Please take about 2 or 3 minutes to read this first, or the student. Maybe 3 minutes to read it, and then we can discuss. So if some of you already finished reading, you can try to look at the question and see if you can answer the question. All right, so any of you haven't finished reading? So basically, it is like, I think the key story is that the index when they construct the index, right? So they use the number, the index construct return for the 5 years period prior to 2001 based on the initial group of company constituting the index in 2001. And the key is that in 2004, during 2004, 2006 to 2006, there are like a war, right? Series of military confronting. So it's kind of the war affect the economy and the financial market, and the stock return. Okay, so and then also, so this is one of the event, the key event in 2004 and 2006, and the other event is that about the inverted yield curve. So what is inverted yield curve? Any student want to explain to the class what is inverted yield curve? Thamachot ค่ะ
So normally the yield curve for the short, it will look like growing from the bottom left to the top right, because the short term will yield less yield, and the longer term will have a higher yield. But for the inward yield curve, it is opposite. It's starting from for the long term bond, it will have higher yield than the longer term bond.
Okay, so for a normal yield curve, right? So a normal yield curve, shorter dated bond offer lower return than long term time to maturity bond, right? Short term bond has lower yield than long term bond. So when you plot a yield curve, is like upward sloping. So that's normal yield curve. And what can be the reason to explain the shape of the normal yield curve? Any student want to answer me this? Why the normal yield curve is upward sloping? อัธวุฒิค่ะ
Because people generally think that longer term bonds are more risky, and that's why they require the compensation for that more than short term ones.
Yeah, of course, that's the maturity risk premium, right? Because longer term bond has higher level of maturity risk premium, and also it reflects the expectation on the economy. If the market expect economy to grow in the future, the rate should be higher, so it's upward sloping. But inverted yield curve is happen from time to time. I don't know, maybe it's worth to check right now, no? What's the shape of the US yield curve, yield curve in the US right now? Because many times the prediction power is about I think more than 60%, maybe around almost 70% can predict recession. Inverted yield curve can imply an expectation that the long-term growth will be lower than current than present. So it can be a good indicator of recession. In the past, I think about 6 to 7 times out of 10 times. Inverted yield curve correctly predict recession about 3 to 4 years ahead in advance. All right, and in this question is say that yield curve is now inverted because of high inflation at present. Inflation is currently high 6%, and the long-term forecast on inflation is only 4%, and the yield curve is inverted. Normal is upward, but now it is inverted. All right. And the first question, they asked you if the inclusion of index return prior to 2001 would be expected to, and the answer is to bias the historical equity risk premium estimate upward. So this is about survivorship bias, right? Because so like we assume that during this bad time, so there will be the return is poor, and it can impact many company to get out of the market, and it's distort the return, right? But if you include this period, so it's kind of inflate the number. Okay, so this is about survivorship basis bias, and this one, and this one is kind of related, right? So the event in 2004 and 2006 would be expected to bias the historical equity risk premium estimate downward, because during that time the return on the market is poor. Okay, and this one, the last question, maybe I make it larger. They asked you, in the current interest rate environment, using required return estimate based on the short-term government bond rate and a historical equity risk premium defined in the term of short-term government bond rate would expect it to. So in this one, okay, using required or return estimate based on short-term government bond rate, which is abnormally high at the moment, right? And you add this short-term rate that is abnormally high by the risk premium that estimate from the normal yield curve. So in this case, the answer is that it will bias the required return upward. This is because with the equity risk premium estimate in the past, given the normal yield curve, you add this to the current risk free rate, which is abnormally high, right? So it will result in the overestimate bias, upward bias of the required return. What else? So I think that's it. Actually, this one is easy. Maybe since we still have time, I will go through this as well. The last question, to equity issue have the same market risk, but the first issue has higher leverage, greater liquidity, and higher required return. The question is, the higher required return is most likely to result, the result of the first issue. So you can see that if we compare with the first issue with the other issue, the first issue has higher required return, right? And they say, what are the reasons for the higher required return? The first issue has higher leverage, so it means higher level of financial risk. Greater liquidity, so in this case, greater liquidity, lower level of liquidity risk, right? So the higher required return, so the higher required return should be from higher leverage, not the greater liquidity. So the answer is higher leverage. No answer also. So yeah, the answer is the higher leverage, not greater liquidity, because greater liquidity is lower level of risk. So this the answer question number for question 12 is this A, high. Oh, sorry, is this B, higher leverage, right? So any question? So if you don't have question, we can now end the class earlier, since I think you're tired for the whole day. There are students asked me through the chat, will the quiz be written based on type? Oh no, the quiz, since this is online exam, actually I already mentioned in the very first day that I talked to you that the quiz and the midterm exam will be done through the blackboard system, and it will be all multiple choice because this is online. And the fact that I decide to use multiple choice exam because it will prevent. I want to prevent the I want how to say I want you to try to do it by yourself because my multiple choice exam will be random. So each student will have different question and the answer will random as well. And after you finish one question, you cannot go back to redo it, right? So that's will lower the chance for you to share the answer to your friends. So that's why it will be like this, and it will be an open book because actually I don't like student to open book, but since it's not under control, since it's online, so I allow you to open book. But the way that I will do it is that the number of questions will be quite, will be more than normal exam. So you will have very limited time. So if you spend time to open book, so I don't want you to open book, just to be frank. So if you don't understand and you spend time to open book or try to seek for answer from elsewhere, you will not be able to finish the exam. So that's it. So even if it's an open book exam, you must make sure that you understand and you don't need to open book, because if you try to open the book, you will not be able to finish the exam. Yeah. Calculator and anything you can use. Yeah. Anything else you want to ask? Okay. So you don't. So if you have anything to ask, you can raise your hand. Yeah. ค่ะเมย์นะวันค่ะ
How many questions in the quiz, and how long it gonna take?
I will tell you later, but not too long because we have a class also. It's
Okay.
maybe 30 minutes maximum. Yeah. Okay. So see you on. So now it's this Wednesday. See you on Friday. นะคะ Chayani, do you have any question?
Adanka, because we have 2 classes per week now, I wonder if the midterm will include double of the content as well.
So the midterm exam will include the topics that we learn up to the date. So it will be just until dividend discount model. Yeah. So all the material that we learned before the midterm exam will be included in the exam. But for the final exam, so the midterm exam is 30% and the final exam is 35%. Just a little higher score allocate to the final exam. But the final exam will, even though it's not directly involve the theory that we learn, include the theory that we learned before the midterm exam, but it is kind of, it's need the understanding as well. It's comprehensive because, like, for example, we will learn about free cash flow model in the final exam. And in order to be able to do free cash flow model, you need to understand the cost of capital. So, it's kind of more comprehensive in the final exam. Okay, so any other questions?
So does that mean that there will be more content for midterms than the final?
So what I try is to explain is that the midterm exam, okay, maybe more topics, but the final exam is comprehensive. It's integrated the knowledge in the midterm exam as well. It will not be asked about like the theory, but you need to have understanding in the midterm exam. So it's comprehensive. So it means that the content in the midterm exam, the understanding will be applied in the final exam as well. So that's why, the score mix is kind of, it's 35 because it's also, the midterm is it's 35 final, right? It's like 30, 35. I don't know. I'm not sure whether it's midterm or final, but anyway, but the final, even though the topic is less than midterm, but it's comprehensive. It's required the knowledge from before the midterm exam in order to do the final exam. Okay. Okay, so any other question? Okay, so if you don't have question, make sure that you understand what we learned, because we will have the other topics that we will learn this Friday and next Tuesday. And on next Friday, there will be a quiz that include the topic on cost of capital and the next topic that we're gonna learn, economic profit and residual income valuation. For the efficient market, it will be in the midterm exam, but it will not be on the quiz. Okay, so if you don't have any question, then see you again on this Friday, 9 o'clock. Okay, so